Bring in Scott Wren. He's standing by, Wells Fargo Senior Global Equity Strategist. Scott, you can buy into a downdraft like that, assuming that you can ride out an incredible amount of volatility, right?
That's right, Dagan. And really, you know, for us, this is no different than the last 5 years. I mean, on these pullbacks, this is difficult for retail investors to do. But as we've been telling them for 5 years, pullbacks are opportunities. We're probably in the 7th inning. There might be one out of this cycle, but there's more baseball to be played. And I definitely don't think this cyclical bull market is over. So you need to be thinking of ways to take advantage of this volatility. It's tough to do, but you need to be looking at stocks and industrials, which have outperformed the S&P 500 since July. Technology, consumer discretionary, those are the things you want to look at. Cyclically sensitive. You know, this recovery here in the States is going to continue, and I think you're going to see better news abroad, too.
But, Keith, I'm going to bring you in here. The choice isn't just stocks. I mean, you can buy fixed income, and we're going to talk about that later in the hour, but I'm not saying junk. But Treasuries certainly look a whole heck of a lot more stable. And if you think that we're going into a downdraft in the economy, maybe not even a recession, but an economy that can barely grow, you want to own Treasuries. Certainly that's been the trade this year.
Yeah, man, it's an ongoing reality check. If you have my view, the growth slowing view, that's one view. You're long Treasuries. If you have the other view, which a lot of people have, that the economy's fine, we're in the 6th, 7th inning, whatever it is, you have another position. That's what makes a market. The most obvious thing to me right now is the link that Stephen Schork made, which is the link from deflation to the credit market and the profit cycle. So what we do is we actually have a chart here that just shows you that it has happened every single time, which I think is a pretty good batting average, that every time that corporate profits are negative for 2 consecutive quarters, and yes, we do think it is the 2nd consecutive quarter, which is the 4th quarter, the U.S. stock market undergoes a crash. In other words, a 20% or more decline. And again, you don't have, actually, you have to have a full-blown U.S. recession to get that correction. So again, I think I got both right. I think I got the slowdown right, and I got the stock market side right, and I think people are going to have to wear this. On the trading side of it, I'm more in the camp with what Murph said. I mean, obviously, if the futures are down 40 or 50 handles, you got to buy something today. I mean, certainly if you're short stocks, you cover some stocks. But in the intermediate term, I think the next 3 to 6 months, you're going to see most people on Wall Street come to our view that corporate profits are negative for stocks. And that's a super obvious fact if you look at that chart.
Scott, did Keith convince you?
No, absolutely not. I think you're going to see 6-7% earnings growth this year, and as we all know, not any mystery. You know, in the 3rd quarter, if you take out energy earnings, which you can, you know, not to play this game, but you take out energy earnings, and earnings were up about 10%. So most of these other sectors are doing well.
Right? We should play the game. If I took out my goalie, I would probably get scored on.
This is a supply situation in energy that's driving down oil, that's making people afraid of the high-yield energy, high-yield bond market, and people are fearful that Chinese growth is going to collapse, which, you know, based on our research, is not going to happen. I mean, this is an opportunity. You need to take advantage of this. We're in a slow growth environment. That's not going to change. We've been in it for 5 years.
Scott,
low inflation. I mean, nothing's changed.
I'll just point out, though, that one thing that makes some individual investors wary of buying into this market is because in the last year or so, and hedge fund managers, many of them made the same mistake, but as oil moved down, they had people selling them MLPs. They had people selling them closed-end junk bond funds. And so, you know, now's the time to buy. So what I'll push back on is that people get burned, and you burn them once on energy, for example, they're not going back again. They're not going back for a second helping of spoiled food.
Dagan, that's been a huge problem in this entire rally, is that people who have been in the market for a while, they got burned in 01 and 02. They got burned again in 08 and 09. And so they don't want to touch that hot stove. And look what they've missed. They've missed a huge rally off the March 2009 lows. So that's just human nature. And it's, you know, part of my job is to try to look ahead, make projections, see where the economy's going, and then see how that's going to affect these various sectors of the market. So it's understandable. That's human emotion, and that's, you know, that's a tough thing for investors to do, is to step in when there's blood in the streets, and there's blood in the streets. So
Scott, thank you for that. Scott Wren down at Wells Fargo, and Phil Flynn as well. But I'll